Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
Matt Justice here for Tackle Trade to discuss a little bit about insurance in the financial markets. Now, if you've ever been to one of our webinars, or you ever seen me teach at a 3-day basic training presented by Rich Dad or Legacy Education and whatnot, protection is the number one key in trading. Protect your money, protect your capital, set stop losses, set targets, lock in profit, trail stop losses, reward to risk ratios, position size, risk rules, diversification, everything we talk about in our trainings, in our videos, in our trading system, everything is about protecting money. We should never make a trade unless we're out there protecting the trade, protecting the portfolio as a whole. Well, given the fact that we're in a very distinct long-term cycle in the market, for example, if we pull up the S&P 500 here, we know nothing lasts forever. As you can see, we have these bubbled markets to a certain extent, and here's the dot-com market, lasts about 5.5 years, crashes back down. Here's the subprime market, lasts about 5 years, crash back down, and now we're in the latter stages of what we call the Bernanke market, which is now going on 6 years, which is just slightly over what we saw in the bubbled markets of the dot-com and the subprime market as well. And I think it's important to understand the difference between upside potential versus downside potential here. And after the end of a 6-year historic run here, and we know nothing lasts forever, just looking at this movement specifically, you can see up towards the top here, we're starting to see a lot of slowing momentum, unlike we've seen in this entire market, unlike outside of the early summer, early fall of 2011 when we started seeing the European debt crisis. So we're starting to slow down up here at the top tremendously, and I just see there's a lot of downside risk here. Can the market continue to run? Absolutely, it can. But when you're looking at from a perspective of, okay, we're at the end of a 6-year run here. We know the market cycle, including bear markets, bull markets, last only about 7 years on average, in terms of its average price movement and its average GDP movement as well. To me, it's like, okay, it's time to protect. And when you're looking at, say, a lot of the retirement accounts out there, whether you're talking your 401ks, your TSPs, your IRAs, whatever your mutual funds are, whatever your market ETFs are, whatever your long stocks are, you're what we call a directional trader or a delta-based trader. So for example here, let's say we have the S&P 500 here, and we're looking at somebody that basically just has a retirement account allocated in mutual funds, market-related ETFs, whatever the case might be. This is what your risk graph looks like right here. It's what we call vertical, meaning as the market goes up, you're going to make money. As the market goes down, you're simply going to lose money. That's aggressive. I don't care if your financial advisor, your wealth manager, or Wall Street or anybody like that tells you anything else out there. You are the most aggressive form of investor when you invest in mutual funds, when you invest in market indexes, when you invest in just stock. You're what we call a delta trader, which means you have to be right. You have to be right if it goes up, you got to be right. If it goes down, you got to be right. You have to be right in your analysis. So if the market continues to go up, obviously you're going to continue to make money here. If it even goes up 10%, you're going to make, on a $100,000 investment, you're going to make, right around $10,000. If it goes down 10%, you're going to lose right around $10,000, just depending on what mutual fund you're in, what fees are associated to the fund, and yes, you pay more fees than what is announced, and so on and so forth. So given the fact that we have downside risk here, I think it's important to add insurance to the portfolio. So if I basically take just a small percent, okay, of the portfolio, we'll say right around, and let's go out to, let's delete that one. Let's add a insurance position, and let's go all the way out to January of next year. Obviously, if it gets close to January, we could roll to a deeper month, but I'm just going to go an at the money strike price here just to make things real simple on the analysis here. So if I buy, the current stock price is, 20, we'll call it 207 here. There's, lots of strike prices on the S&P 500. So if I buy the current strike price at 207, and I just put 5% in the portfolio, just 5% in the portfolio, and I say we trade, 4 contracts, for example. So we're going to trade 4 contracts here on the 207 strike price. Look what happens to the risk graph. No longer is it vertical, but now you're starting to see how it offsets that risk a little bit on 5%. So if it drives down, say 10% from 208 to 188, for example, instead of losing $10,000, you only lose $4,000. You've covered $6,000 of risk just through a 5% position size. Well, if we increase that to, say, a 8% or a 10% position size, all of a sudden look what you have on the risk graph. As the market goes down even 10%, you don't lose $4,000, you basically break even. And if the market crashes like it did last time, in 07, 08 to coming into 09, or like it did in .com, instead of losing 50, 55, $60,000 and starting the next bear market, starting the next bull market with a, basically a, $50,000 position, and then you spend 5 years just to make up what you lost in the bear market. All of a sudden you start with around $120,000 just in terms of the percent. And then let's see what good old what a George Soros trade looks like here. A 20%, 22% position size in the market, and all of a sudden you make $130,000. But the most important thing I want you to see here, let's go back to kind of that 10%, 12% position size, is this. What if you're wrong? Well, if I'm wrong, I can still make money. And what if I'm wrong by saying it's not going to go down? I can still make money. And it's the purest form of insurance out there. The reason it's the purest form is, unlike your house, your car, your boat, your truck, your life, your health, your insurance on your cell phone. We practically insure everything in our lives except our retirement accounts. But if you can add that insurance, it doesn't evaporate every single month. You don't lose 10% you do like you do on your house or your car or your boat or whatever you have insurance on. It's the purest form of insurance because it lasts for the next 6 months in the marketplace. And then you could always roll it out to a different expiration date as it gets closer. It's a beautiful form of insurance. And if you like what you see here, go see what we do elsewhere at Tackle Trading. Go see what we do as a pro member, what we do in our scouting reports for our students as well. I think the insurance position is appropriate right now. It's more expensive to put that in that hedge on right now than it was even last week, because where the volatility index went just today. But if you can add that insurance position today, volatility is still really low, which means the insurance is going to be lower today than it will be as the market starts to break down. And if we start to see what happened in the U.S. markets, what we've seen in China, what we've seen in Brazil, what we've seen in Greece, what we've seen in Russia, what we've seen in some of the other financial markets out there, that insurance position is going to be absolutely 100% needed, so that you can stop worrying about your retirement, you can stop worrying about the market, and that'll give you the flexibility to start going out there and making other forms of trades, other investments, other cash flow strategies. But I want to ask you guys just one question. I'm going to leave this with you. Where is your risk? The biggest risk you have here is not if it goes up or down, it's if it does nothing. That's your biggest risk. If it absolutely does nothing and it stays at 208, for example, for the next 6 months, you walk away from the entire marketplace and you literally just leave. You never check it. You wait till the end of January, and all of a sudden you've lost your premium in the options, and that is the absolute biggest risk. Obviously, we're going to cover that risk too, because that's what we do at Tackle Trading. Now, really quickly, this can be added to absolutely anything out there. Sometimes we have to get them a little bit more creative with retirement accounts, because 401ks are a little bit more, more regulated than IRAs and individual accounts. Some companies will only let you, in a 401k specifically, will only let you invest in certain aspects of the marketplace. But realize this, the protected put option can be applied on anything, absolutely 100% anything. Sometimes maybe you have to use your IRA to protect the 401k if you're limited in what you can do. Maybe you have to do it in an individual account. Whatever the case is, just do it. Get with a mentor, get with a coach, talk about it in your labs, talk about it in your coaches shows. Ask the coaches over at Tackle Trading what they would do. Participate in the forums, but for whatever it is, get the help you need to protect the things you work so hard for, and that is your retirement. Because if you do not, I promise you, the traders on Wall Street, the hedge funds, the pros out there, the institutions, the high frequency traders, they know how to get your money in a retirement account. They know what's going to happen in the next crash. It's time to prepare for it right now. Matt Justice for Tackle Trading. If you enjoyed the video, go ahead and like it over there on YouTube. Make some comments in the comment section at tackletrading.com. Enjoy the week this week in the market. We'll see you over there at tackletrading.com. Get in the game, one trade at a time.
Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.